Hi everyone, I wanted to do a quick post today on a question that comes up a lot with my small business clients, and I actually saw this posed in a social media group the other day about cash payments in a business. So the question that often comes up is whether or not cash payments from the customer to the business are taxable or if they need to be reported to the IRS. And the short answer to that is yes. IRS rules state that unless there's a specific exemption to income, it is taxable. So they don't care if it's paid in cash or gift cards or written with check or credit card or paid in cryptocurrency. If you're paid for services, you have to pick up that income on your tax return. So a lot of people think that if there's no paper trail, if there was no check or no credit card payment, and there's no 1099 sent to the IRS to tell them how much one business paid another at the end of the year, that you don't have to report it. The IRS will never find it. It's an easy way to save on taxes. So I can tell you, if you do get audited, the IRS is a little smarter than that, and they're going to come in and they're going to trace it back to see if there's possibly missing income somewhere. So if they know, especially if you're in a business that they know is a high cash type business, they're going to look a little harder. So they will look at your personal bank statements. They'll look at the business bank statements. They'll compare the income that you reported to the lifestyle that you're living. So if you're driving a nice vehicle or a brand new vehicle, or you're living in a very nice house with high real estate taxes, and yet your income shown on your tax return can't justify being able to meet those expenses, they'll dig a little bit further and they'll ask, where did that income come to be able to pay that mortgage, or go on the vacation that we saw on your Facebook page last year. Where did that money come from to go to the Caribbean? So they will look into that. They will ask questions. They'll assume that you had cash coming from somewhere. Maybe you took money, cash out of the cash register and took it home and didn't deposit it into the bank account. So it never hit that, but it was earned. And they'll ask, was there inheritance? How much money is your spouse making to be able to help pay these bills? So just because there's not a paper trail does not mean that the IRS can't catch up with you and can't figure things out, or just assume that there was more income. If you can't prove them differently, sometimes the burden of proof is on the taxpayer, not on the IRS. So they will come in, and trust me, the penalties and interest are much, much worse than if you had just paid the tax in the first place or worked with an accountant to find other legitimate deductions to lower your tax bill. So just be cognizant of that going into tax season. Don't rely just on the 1099s that you receive to report your income. Make sure you have a good record keeping system in place, whether it's QuickBooks or Xero or even a simple spreadsheet. Make sure that those, are recording all of your income, all of your expenses, and that you're being accurate on your tax return before you file those, just to avoid any issues with the IRS. So I hope this helped clear up that issue. If you have any questions, please let me know.